Hello friends and welcome back to lesson number 5. This is the sixth video of inclusive growth. In this video we'll study a particular topic in inclusive growth which is called economic inclusion and financial inclusion. Okay, so many a times there are questions on financial inclusion and there is a confusion in many of the students as to what is the difference between economic inclusion and financial inclusion and inclusive growth. So most of the times we use these terminologies interchangeably. However, there is a difference between all these three terminologies, and we'll learn that here in this video so that you have a conceptual clarity. This will also help you in answer writing and also maybe during your interview also. If any question is asked to you about financial inclusion and economic inclusion and inclusive growth, so I hope this will be helpful. So first of all, let me show you how these three terminologies, although different from each other, are very much related. Okay, so they are different terminologies, they mean different things, but they are definitely related to each other. So first of all, when we talk about inclusive growth, the first terminology, we can say that inclusive growth is the broadest terminology. Okay, it is the broadest, so it covers everything. When we talk about inclusive growth, basically it covers everything. Now what is everything? First of all is that inclusive growth means that to reduce poverty and inequality, then to give equal opportunities to participate in economic activities to all the people, equitable distribution of resources, etc. Then welfare measures for poor. So government is taking various welfare measures, like giving them pension, giving them free health care, giving them health insurance, giving free education. So these are the various welfare measures for the poor. Then creation of jobs. So government also works towards creating jobs, various schemes in order to attract investments and increase manufacturing. So that also is a part of inclusive growth, so that people benefit from it. Then inclusive growth also covers sustainable development, basically environmental conservation, okay, or sustainable development, so that our growth and development does not destroy the environment. So we conserve the environment also, because environment itself is a big asset for any country. It is a big asset for the entire globe, entire world as such. So environmental conservation is also part of inclusive growth, which is also in somehow related to sustainable development. So again, when we talk about environmental conservation and sustainable development, we are talking here about intergenerational equity. Okay, intergenerational equity. And of course regional balancing, so balancing the inequalities between various regions, various states, various districts. Aspirational, for example, aspirational district program is a program which aims at balancing the regions. So the aspirational districts, or the districts which lag behind in developmental parameters, they are given special attention. So that is a regional balancing. Similarly, special category states are given more funding, special schemes are there for them. So again, that is a step towards having regional balancing. So all these things, everything is included in the inclusive growth. Okay, so inclusive growth is very, very broad. Now, out of these various aims and objectives in inclusive growth, if we look at these first four objectives, okay, like reducing poverty and inequality, then giving equal opportunities to participate in the economic activity, then having welfare measures for the poor, creation of jobs, so all these come under economic inclusion. So these are the various things which can be called economic inclusion. Okay, because here we are making poor people, including them into the economic growth process by reducing their poverty, by reducing inequality in the country, by giving them opportunities, by giving them pension, by giving them monetary support, income support, cash transfers, basic incomes, then giving them jobs, creating jobs. So everything comes under economic inclusion. And of this economic inclusion, financial inclusion is a part of economic inclusion, because financial inclusion comes under this category, giving equal opportunities to people to participate in economic activities. So financial inclusion means that, giving access to credit, giving access to banking services, giving access to insurance, giving access to investments. That is a financial inclusion, and it is a part of economic inclusion. Basically part of this activity, giving equal opportunities to participate in economic activity. So if we look at it in the form of a Venn diagram, so we can say that inclusive growth is the broadest set. Okay, so this is inclusive growth, the big one. Then economic inclusion is a part of this, small part of this, and of economic inclusion, this again, this small part, this one is financial inclusion. Okay, so now I hope now you understand this various terminologies, how they are related to each other, but how they are different from each other. So just try to understand this. So economic inclusion refers to ensuring that individuals and businesses have equal opportunities to participate in economic activities, leading to fair access to labor markets, entrepreneurship, and financial resources. So one of the ways in which economic inclusion is achieved is by giving them access to different kind of markets, like labor markets meaning job opportunities, entrepreneurship meaning ability to start a new business, and also of course financial resources. So, and this access to financial resources comes under financial inclusion. Financial inclusion is a subset of economic inclusion and focuses on providing affordable financial services, including banking, credit, and insurance to underserved and unbanked populations. So where there are no banks, where there are no financial institutions, financial inclusion works towards providing them with all these financial services. So what are the different financial services? Of course, the banking services. So banking services meaning opening of saving bank account, okay, or getting doing fixed deposits, using banking services for transfer of money, okay, for transfer of remittances from one place to the other. Then of course access to credit meaning loan, to take different loans, maybe to buy a vehicle, to buy a house, okay, for education purpose. So that is access to credit. Insurance meaning different kinds of insurance, so which is a kind of social safety net. Okay, insurance for health, insurance for vehicle, insurance for house, insurance against accidents. So different kind of financial services. So all these things, and of course financial literacy. So if you want to do all this, you will need education about different financial markets, different financial services. So financial inclusion includes financial literacy also. So this is a part and subset of economic inclusion, because the ultimate aim of providing these services to the poor people is to uplift them economically. Okay, economically uplifting them. That's why financial inclusion is a subset of economic inclusion. What are the examples? Microfinance institutions, MFIs. Okay, this we have covered in our prelims videos. You can go watch the prelim videos if you have not watched them yet. I recommend you that you first finish the prelim series and then you watch the main series. So microfinance institutions provide small loans to rural entrepreneurs who lack collateral. So collateral meaning it is a security that you provide to the banks against which you get the loan. For example, you go and buy, you want to buy a vehicle, okay, and you want a loan of say 2 lakh rupees. Okay, so you want to buy not 2 lakhs, say 10 lakh rupees. So you want to take a car which costs 10 lakh rupees. So the collateral, bank will ask for a security as to what is the security that you will pay back this 10 lakh rupees. So that security is called collateral. So that security may be the vehicle itself. Okay, the vehicle itself may be the security, or they will ask you for some additional security, like you can keep some fixed deposit against it, or you can keep some gold against it. So different kinds of collaterals are there. So people who don't have collateral, because in rural areas there are various poor people who don't have any collateral to get the loan. For example, if somebody wants to get a personal loan, of to do some medical treatment. So there is no asset, there is no vehicle, there is no house against it. So, and they also don't have any collateral. So in that case, microfinance institutions can provide them small amount of loans to rural entrepreneurs to do business. Okay, so if they want to start some small business, then these institutions will give them loans without collateral. Then zero balance accounts. Okay, so bank accounts should be opened for all the people with zero balance. So even if they don't deposit anything, their bank account should operate. Previously, the bank account used to ask you for some minimum balance, but now under the Pradhan Mantri Jan Dhan Yojana, zero balance accounts are being opened. Then digital payments. Okay, this is a very very big example of financial inclusion, because now digital payments are possible in rural areas also. Cashless payments in remote areas is also possible, because of which the businesses in the rural areas increase and people don't have to really handle cash. So they are getting connected to the financial system through digital payments. Now, what is the importance of banking, digital finance, and microcredit for financial inclusion? What is the importance of all this? Why do we talk about all these things? So see, banking plays a very critical role in financial inclusion by offering deposit accounts, credit access, and financial security. So this is, of course, this is very very basic and very very straightforward. Banking provides, as I told you, fixed deposits, saving bank accounts, so that people can put their money with security. They can deposit their money there, and which will be safe. So there is a financial security also. They can access credit also. So banking plays a very very important role in all that. Then digital finance, like mobile banking, fintech apps, blockchain solutions, enhances accessibility, reducing the dependency on physical bank branches. So if we use digital finance, then we don't need to really visit banks to do various transactions. So again, very very important. Then microcredit supports small businesses, people who don't have collateral, and small entrepreneurs in rural areas who lack access to formal banking. So these are the important, these we have already discussed. Then payment example. What is the example? Payments bank. You must be knowing that in India now we have payments banks also, and Indian Post also provides a payments bank. So the payment banks belong to various institutions. So it can be a private institution or the government, for example Indian Postal Payment Bank. Then there is a payment bank by some private companies also. So what is the role of this payment bank? Again, we have studied this in the prelims videos. Payments banks, they provide basic banking services to migrant laborers and small businesses. Now what is basic banking services? Like for example, transfer of remittances. Okay, like if somebody wants to send money to his family in a village, so that is possible through these services. Then microfinance institutions such as Grameen Bank. What is the example of microfinance institution? Grameen banks. They have enabled millions of poor individuals, especially if you want to start business. So what they do is they provide small loans to women self-help groups to do their businesses. And government initiatives like PM Jan Dhan Yojana, Mudra Loan Yojana, Digital India Initiative, these are various examples of the banking, digital finance, and microfinance, and how they are important towards financial inclusion. Now what are the various challenges when it comes to financial inclusion? So there are obviously various regional and social barriers that come in between. It is not very easy. So it is easier said than done. On paper it is very easy to talk about financial inclusion and giving banking services to the people. However, there are various physical barriers, social barriers. For example, there can't be a bank branch in an extremely remote area because of various issues like connectivity issues, like internet issues, and also the bank will decide whether to open the branch there or not, depending on the profitability of their business. So lot of challenges are there. Now what are these various challenges? So the banking infrastructure, which I have already told you, like brick and mortar branch. So brick and mortar branch meaning physical branch, meaning physical bank branch with a proper 4 walls and office and everything. So brick and mortar branches in rural areas in remote areas, in hilly areas, are not there. So people cannot go and actually access this financial resources. So there are various regional disparities which hinder financial inclusion. So there is lack of banking infrastructure. Then there are various gender disparities also. So women are often excluded due to social norms, and also lack of financial literacy. So most of the women, they are not literate in rural areas, and they are not able to use the banking services and other financial services. So gender disparity is another major challenge. There are technological gaps also. For example, smartphone access and internet connectivity, as I have already told you, in many regions are lacking, and therefore digital finance is not possible in these areas. So technological gap is another big challenge. Of course, there are cultural and linguistic barriers. So many financial services are not available in regional languages. Okay, so that is again, and in the rural areas, people don't really understand English. So the linguistic barriers are there, which causes people not accessing the financial resources. There are various cultural factors also behind it. And in India, it has been seen that 67.5% of accounts under the PM Jan Dhan Yojana initially had zero balance. So it is a big pointer that 67.5% of the accounts had zero balance, meaning you can see that what was the situation. So people did not have a single rupee to put in those accounts, only the accounts were opened. But at least now the people have the accounts. So this is basically highlighting the challenge of encouraging financial usage. So people are not actually using these accounts because 67.5% had actually zero balance for a very long time. So it is a big challenge to actually convince people to use these accounts. Okay, so there are various cultural and linguistic barriers also. When we talk about cultural barriers, what are the various cultural barriers? For example, people believe not going to a formal institution, but going to the informal sources of financing like money lenders, etc. So there are various cultural reasons also behind it. There are various religions where giving loan or taking loan is considered to be a sin. So again, a cultural factor which is affecting financial inclusion. Now there is always a debate as to whether the financial literacy be a driver for inclusion, because when we see all this here, we can always say, or we can point out to a common thing, that financial literacy is a big issue, because of which people are not able to access the financial resources or financial services. So is financial literacy the solution? So that is a debate actually. So many people believe that it is not just the financial literacy that will help, but we need to do a lot of other things also. So we'll see what are the various arguments in favor of financial literacy, and what are the arguments which say that financial literacy is not sufficient. So first of all, we will see arguments for financial literacy. Okay, basically arguments where we can say that financial literacy will help financial inclusion. Because why? Because it improves decision making regarding savings, credit and investments. Of course, if people have financial knowledge, financial education, they will think about savings, they will think about taking credit and doing some business, they will think about investments, so that their money will grow. So obviously financial literacy will help increasing financial inclusion, because if people know about it, only then they can actually access these services. Then it reduces over indebtedness by educating individuals on loan management. So as I told you, many people, they still believe in informal sources of credit. So once you give them literacy about financial services, what are the various interest rates in the market, because many a times these money lenders, they'll charge a lot of interest rate, almost 3, 4, 5, 10 times in many areas than what is the market interest rate. And people are always in a state of perpetual indebtedness. So in order to reduce that over indebtedness, the education, financial education, can help people in managing their loans. So again, yes, financial literacy can help people having better financial inclusion. Then it encourages entrepreneurship by informing people about financial products. Of course, if there are various kinds of financial products, like various kinds of loans available, various kinds of insurances available, so people will obviously think about doing businesses, because now they have access to money, they have access to finances through which they can do the business. Now, there are various arguments which say that financial literacy is not sufficient. So what are these arguments? First one is that access is more important than literacy. That is what people say. People say that even if people have education and knowledge about financial services, but if there is no bank branch in a village, what will people do? Where will they get the loans, and where will they open their saving accounts if there is no bank at all? So access is more important. Access meaning they should be able to go to the bank. If the bank is set 50 kilometer away in the district headquarter or in the taluka headquarter, then there is no point of so that doesn't mean an access to financial resource. Access meaning it should be within their reach. So people should be able to use it on a daily basis or whenever they need. So access is more important than literacy. That is what people say. Again, this is correct. Then there are various behavioral factors also. Even if you educate people, they will not change their behavior very easily, because there are trust issues. So people will not very easily trust the banks. If we put money in this bank, whether we'll get that money back or not. If we put money in this investment in the mutual fund or any other stocks or bonds, whether we'll get the money back or not. So trust in financial institutions, cultural resistance, as I told you, again is very, very important, and they play a very critical role here. Behavioral factors. So it is not just education, because people will take financial literacy and then they'll forget. They'll start behaving in the same way. So behavioral factor, again, very, very important. Then government intervention through direct benefit transfer and social security is sometimes more effective than just education. So when people actually get money in their account through direct benefit transfer, like for example, we give them pension through DBT, like Indira Gandhi old age pension, Indira Gandhi widow pension, okay, various kinds of pension, or even Atal pension yojana. Then Pradhan Mantri Fasal Bima Yojana, if any crop losses are there, then people get the money in their bank accounts. Then PM Kisan Yojana, the farmers get money in their bank accounts. Even Manrega payment, they happen through DBT mode in their bank accounts directly. So government interventions through DBT, they start making people use financial resources more than just giving them the education about it. So government intervention is more important. Example, Atal pension yojana aimed at providing pensions, but lower financial literacy led to poor uptake. So again, here Atal pension yojana was a yojana which aimed at providing pensions to the people who belong to the unorganized sectors. However, lower financial literacy, people did not have knowledge about what is pension, so the uptake was poor, meaning people did not really opt for it, for the Atal pension yojana, because they did not have knowledge about it. Maybe there were some trust issues, maybe there were some cultural factors. So in conclusion, we can say that economic and financial inclusions, they are essential for sustainable development, for driving growth, to reduce inequality, and to enhance the financial security of the people. And banking, financial services, digital finance, microcredit, these are enablers. Okay, what are they called? They are enablers. So they will enable people to grow, to come out of poverty, to start business, etc. But government initiatives are very, very important to overcome the regional and social barriers. Okay, so there are various regional barriers, various social barriers, various cultural barriers. So government initiatives are very, very important to actually address these challenges. And financial literacy is important. Of course, we saw that people should be aware about various financial services, but access and incentive is equally important. Okay, so people should have access to financial resources, and also they should be incentivized. There should be incentives to use it to overcome the trust issues, okay, to overcome the cultural issues. So access and incentives are equally important. They play a very significant role in achieving the real financial inclusion. Okay, so real financial inclusion can be achieved by a mix of access, incentives, by having enablers, various government initiatives, and of course financial literacy. So real financial inclusion comes from all this. So these are the various pointers here that will help you. So I hope you have understood what is financial inclusion, how it is leading ultimately to economic inclusion and ultimately to inclusive growth. We'll continue in the next video. Thank you.